For most of us, applying for a mortgage will be one of the most important applications we make. So it's really important to get your credit report in top shape. But to get yourself mortgage fit, you'll need to start your financial training as early as possible. Starting this process around a year before you apply will give you lots of time to strengthen your credit report and score. When you apply for your mortgage, you want to make sure your application is accepted and you get the best rates. So here's a training plan to get your credit report in great shape. You want to start a 1-year training plan with a thorough review of your income and spending well in advance. Now, along with your credit report, lenders are likely to take a good look at your bank statement transactions when you apply, so try to keep your spending under control. Check your credit report and score. Now, a credit report is a record of credit you've used in the last 6 years, along with other relevant records such as electoral roll, court judgments, insolvencies, and credit applications. Importantly, if you haven't borrowed much in the past, this is the time to start building some credit history. So try getting a credit builder card to use for small essential spending each month and pay it in full. Now, if you can get any utilities, for example, gas and electric in your name, that will also help. And finally, home broadband or mobile phone contracts can also help. It's really important to start now because you need about 1 year to build a solid credit history. But remember, be consistent with payments. Lenders want to see a strong track record of paying back credit on time. So make sure you don't miss any payments for the next year. And you can avoid this by setting up direct debits. Now it's time to start our 6-month high-intensity credit training. Now, with about half a year to go until you apply, try to avoid applying for new credit accounts, including energy and broadband. Now, mortgage lenders don't look too favourably on recent applications for credit. So try not to do this up to 6 months before making your application. Also, if you can, try and reduce any existing borrowing. Persistent or increasing levels of debt can cause alarm bells, and maxed out credit cards are also bad news for credit scores. And if lenders see your borrowing has risen recently, this could also cause concern. Now, it's a good idea to keep an eye on your credit score using a free score service such as Experian, and you'll be able to monitor your progress and measure your gains. Also, if you're financially linked to anyone that you shouldn't be, then get this removed with each credit reference agency. This is called a financial disassociation. Now, finally, you're ready to apply and feeling money positive. Remember that each mortgage lender has a different lending criteria, so it's important to start researching who you're likely to be accepted with. Shop around for the best mortgage deal without damaging your credit score by using comparison services like Experian, and they only register a soft search, which isn't seen by other lenders, so you can use this as often as you like. You can do quotations with individual lenders if you choose to. These are also soft searches, so don't affect your credit score. They'll help give you an idea of whether a lender will consider you and perhaps the rate you might be offered. But if you do have special circumstances, like being self-employed or have had past financial problems, then consider using a whole-of-market mortgage broker or speak to lenders direct for guidance and advice. And finally, it's a good idea to get your admin together before you apply. Each lender is different, but make sure you've got some ID and possibly the last 3 months of wage slips and a couple of recent bills or statements within the last 3 months.